Welcome, everybody. I think we are lucky that we got free speeches on very similar topics because it's gathering people of the same mind, thinking about the same issues. And I'm happy to welcome Phil Fogel here to give us his take about blockchain and carbon and climate solutions.
Thank you very much. Thank you all for coming out this morning. I'm here to talk about blockchain's role in a transparent, credible climate solution. And actually, building on top of, for those of you who are here for Max's presentation and Alan's presentation before that, what I'm going to do is really zoom out a little bit and look at the market as a whole and what the entire market infrastructure can look like, and then zoom in on a couple different pieces that Flow Carbon is specifically working on. So I always like to start out with this question of, we're talking about the voluntary carbon market, and how voluntary is the voluntary carbon market actually? So pair of quotes up here from crypto's new favorite TradFi CEO, Larry Fink. And he said, every company and every industry will be transformed by the transition to a net zero world. The question is, will you lead or will you be led? Similarly, he also said that the tokenization of asset class offered the prospect of driving efficiencies in capital markets, shortening value chains, and improving costs and access for investors. So when you really take these two things together, blockchain has the opportunity to really lead this transition to net zero and to help actually facilitate the infrastructure that's sorely missing in this market today. So net zero commitments are massively on the rise. So looking at the largest 2,000 companies in the world, we're at almost nearly half of them now having made net zero commitments. And that number is increasing pretty rapidly over the last few years. And these are the companies and cities and states and nations that are actually saying we are going to eventually get to net zero and creating a transition plan from where they are today and what their carbon emissions are today to where they're going to be at zero, hopefully by 2050. Sometimes in many cases for companies, they've made earlier commitments than that. And the whole point of all of this, obviously, is to keep the planet from warming more than 1.5 degrees, which was set out in this Paris Agreement that so many countries are signatories to. And in order to get there, we need to see a nearly 50% reduction by the end of this decade, and then beyond that, a 70% reduction by the decade after that in carbon emissions. And what happens with companies is the way that this works for a lot of companies is you want them to reduce first. You want them to cut their actual emissions as much as possible. But oftentimes that becomes a very expensive process. And so what oftentimes will happen is that companies will go and look at ways to, outside of their supply chain, mitigate the effects of their supply chain. So what that means is they go to somewhere else in the world, they provide money to a project to actually go and do a mitigation outcome. And that is what the voluntary carbon market facilitates, is that transfer of value. So that in theory, if the next marginal cost of reducing a million tons of carbon for a corporation is basically $100 a ton. And somewhere else in the world, for that same amount of money, you can actually mitigate 10 million tons of carbon. It sometimes is economically viable to do so, and that's what the carbon markets facilitate. You take these carbon credits, you retire them, you put that against your own emissions, and you get to a net zero outcome. And so Max talked about how he's creating a new registry. And so the idea is, let's think about a little bit, zoom out on how carbon credits are actually created. What a carbon credit actually is someone does something somewhere in the world that either reduces the carbon footprint or removes carbon from the atmosphere. And that information about how that is done is collected and becomes a set of data. That data is then presented to a body, a carbon registry, along with validators along the way. And they are applying that data to a methodology or a policy framework. And what that policy framework does is says, okay, great, if you plant X number of this kind of tree over this period of time, that is going to be the carbon that's sucked out of the atmosphere by those trees. And so really what we have is a really great use for blockchain. We're taking data, we're applying it to a policy, and out the other side comes a carbon credit. And then ultimately the carbon credits are bought by others and retired. So this market is pretty small today. It was only a few $100 million a few years ago. It's now roughly a $2 to $5 billion market today, but it's poised to grow pretty rapidly over the course of the next decade or so. And a lot of that is made up by the fact that there's a massive financing gap right now for climate projects. We've seen that green bonds are on the rise. Actually, for the first time ever, the amount of green bonds being issued overtook the amount of fossil fuel bonds that are being issued, or bonds that are linked to fossil fuel companies. And what that has done is it's created a way for corporations to do this. But a lot of projects in the carbon space that could do mitigation outcomes that are actually some of the lowest hanging fruit of mitigation outcomes don't require huge amounts of money and wouldn't be done by corporates, right? 95% of green bond issuances were $50 million and above. Most of these projects need access to capital in a much smaller scale, meaning a few million dollars. And so right now, this voluntary carbon market has existed for about 20 years, but there are massive inefficiencies that are keeping it from scaling and keeping it from that $4 trillion actually flowing into the market. Today, we have an incredibly illiquid carbon market. Almost all transactions take place OTC. These are people calling each other on the phone, emailing each other, texting each other, and that's how carbon deals are done. It's paper contract. There's no standard settlement. Settlement can take days or weeks. Someone actually has to go first, so there's no trustlessness in the system. So it's a really inefficient market from an illiquidity standpoint. Is also because of that lack of transparency, right? I can go and do a carbon deal with someone and buy carbon credits for a price, and then no one else knows what that price is, so that price is not seen in the market. So the same carbon credit oftentimes can trade for different price points on the same day, assuming the market actually trades that way. And then on top of that, you have value being sucked out by intermediaries, right? Because this market is so inaccessible to the people who want to use it today, they have to go through middlemen and brokers to do that, and those people are taking a take rate along the way. Corporates have to navigate this entire system, including lots of different kinds of carbon credits, so it's an inaccessible market, it's a difficult market. There is no access for individuals to this market. You can go through, again, an intermediary who can charge you a huge markup to buy a single carbon credit for you to offset your flight, right? And airlines often make that available. But if you actually want to own the asset class, if you want to buy carbon credits, you can't do it today, or at least not easily. And then it's incredibly difficult to secure financing for a lot of the reasons that we mentioned. So Web3 excels hugely at solving coordination problems, which is really what this is. And so now I want to look at what the entire value chain of carbon credits can look like on-chain, and there are lots of people building this. We're really fortunate that this refi space is growing rapidly, and there are lots and lots of projects building at different pieces of this infrastructure stack, and hopefully what this will lead to in the long run is this entire market being built on-chain and all of the infrastructure needed to scale this market being Web3 native. So the first step in a project is the origination. Someone has to go and do the project. They have to figure out where to do it, how to do it, start collecting that data. And so there are projects right now like Alcott, who is committed to doing the first full blockchain-based project in a cookstove project in Africa. Then you have financing. So you need to create financing structures that allow for capital to flow to these projects before the credits are issued so they can actually finance the credit creation. Then there's the measurement, reporting, and verification and certification of carbon credits. That can be built out. Max is building one of the first Web3 native registries, and so that's one piece of this, but there's an entire stack of data collection that needs to happen via IoT devices, satellites, remote sensing, and all of that data should be stored in an immutable fashion, right? So that you can always go back to it and say, what was that data at that time? How did it, if the data changes over time, right? What was that change look like? And how did we arrive at the conclusion that a carbon credit should be issued here? One of the biggest questions in this market is that of quality. As Alan talked about this morning, you solve a lot of those problems by making the data available and allowing for the provenance of how did you reach your conclusion be auditable by anybody. Right now, this market is basically living in Web 1, where all of this stuff is done via PDFs and spreadsheets and emailed around and not searchable and essentially read-only. And so there's a real opportunity to do a Web 3 upgrade to this Web 1 system and make all this data not only machine readable, but accessible and auditable by anyone who wants to audit that data. Then once you have that, you bring the credits available for trading and liquidity, and you can do that on various different layer 1s and layer 2s, as well as in marketplaces that are being created to actually sort through these. And then what all of this means together is that we get a ton of innovative use cases for on-chain carbon that now exist because you have programmable carbon. You've created a carbon asset both at the pre-issuance stage as well as once they're issued that is programmable. And once it's programmable, it's anyone's imagination for how you can use them, from things like automatic fractional offsetting. So you, as Max was talking about also, you have an API that can just connect to any application. You can have it connected into any protocol. So protocols can do automatic offsetting to make their protocols green or just to be planet positive. You can have direct delivery. People can now access the credits, loyalty schemes, et cetera. So shameless plug about Flow Carbon and where we're building in this market. We're focusing on the Web3 side on 3 specific areas. One is on-chain financing, creating those financial structures and creating an ecosystem in which those can operate. The second is the tokenized spot market, taking credits that have already been created and currently live in SQL databases and bringing them on-chain, creating some level of standardization, and then opening up access and liquidity and transparency around those credits themselves so they can trade freely and be held by anybody. And then lastly, we are trying to spur some of these new on-chain use cases to help create ways for people to be programming carbon credits, using carbon credits, and ultimately leading to planet positive actions. So first, in talking about financing, we've sort of looked at carbon markets and the way that they've been financed in the past. They've been done that by very large-scale capital, so think about a bank or a PE fund that will create a financial structure for anything. Usually you're talking about $50 to $100 million as the absolute minimum for them to even get out of bed and think about doing a project. Lots of carbon projects exist in the single $1 million phrase, and the risk associated with carbon projects today is very difficult to understand and very difficult to price. And so what we're doing is taking old financial technologies that have existed for a long time, and we're just bringing those primitives on-chain and creating these things around around carbon markets. So in this structure that we're proposing here, and that we've actually completed a single financing for so far, what we do is we take carbon projects, we enter into forward contracts, basically the ability to buy the credits from the project once they are produced at a specific price. And by doing that, it's sort of a debt-like instrument, except the debt is only repaid upon the issuance and sale of the carbon credit. So it's linked directly to the carbon credit. So it almost is a collateral type inside of a debt. And then what we do is we can take a pool of these. We can buy a bunch of forward contracts from a bunch of different projects, take these $5, $3, $4 million projects, bundle them together into a size that makes sense, and then create 2 different tranches of an investment. So a senior tranche, which represents 70, 80% of the investment capital, which is paid essentially a fixed rate of return. And they get paid first. So carbon credits get issued, they get sold, capital flows back, on-chain a waterfall is executed against, and the senior investors are paid their principal plus their interest before anybody else. And then you can create a junior tranche, which is a functionally first loss capital or an equity-like investment that is, if there are losses, the junior takes those losses first, but if there's upside, the junior also realizes that upside. And then once you start thinking about this, again, this is old school financial technology. It's just building it on chain for, frankly, better fund administration and a better way for these investments to be accessible and traceable. But once you've brought these things on chain, you can actually open up an entire world of programmability on top of that and derivatives on top of that. So individuals can create, or companies or protocols can create index-style products that look at different kinds of carbon projects and create them. You can have corporate offtakes coming directly into the system and actually picking out the specific carbon projects that they want to buy the credits of once they are created at a price. And then you can have direct credit investments, meaning that you can create a product that instead of at the end being a cash-on-cash product, right, it actually flows back and gives you back the credit. So this becomes a really interesting product for corporate treasuries that know that they're going to need a certain amount of offsets, and they can invest in them early on and have some assurances of delivery of those credits later on at better prices because they're capturing that investment return by getting into the projects early, while also mitigating risks by having first loss capital sit in front of them. So what these building blocks ultimately allow for is a really robust financial system of capital. So you can have lots of different project originators. Flow Carbon can be a project originator. You can have the oil majors which run carbon desks. They can be project originators. You can have project developers who are doing lots of different cook stove projects and other kinds of projects be project originators who are providing that first loss capital, basically putting their money where their mouth is to say, I've diligenced these projects, I stand behind them so much that I'm willing to take the first loss if there are losses in this. And then on top of that, you can create mezzanine capital that is sort of a combination of the two, and then senior capital. And where the senior capital comes in a big way is around institutional investors. And we've seen a lot of interest from the likes of Apollo, who has a huge Web3 presence and also has a massive climate fund, right, to come on chain and to utilize these kinds of investment structures in such a way that they are providing, they can provide capital at scale that, few others can. Seeing the same thing from insurance companies and endowments, where they are going to come in and be the massive capital providers. And what's interesting about that is they're actually the ones who are pushing these net zero commitments for companies through their investment process. So now by financing the carbon credits, they're also sort of providing a stamp of approval that says, we've underwritten the process that this carbon credit was created by in the first place, and therefore it's a good carbon credit for corporates to use. And so you create this whole system, and now you can have a secondary market for these style of investments, as well as derivatives that link back to all of this. And because now we're also building a spot market on chain for the carbon credits, these things can actually link together and execute themselves in a trustless fashion, meaning that a carbon credit is financed inside of one of these pools. It can go, then be linked to a derivative in an index fund that can be then hypothecated into something else, or corporates can create their offset portfolios. And then when the credits are actually issued, you can trace on chain exactly where the credits need to go, who owns them, where they need to be sold, or sell them automatically into the liquid spot market. And then that capital can flow back around. So on the tokenization of the spot market side, the way that we are developing this technology to bring carbon credits that already exist off-chain, on-chain today, is we are taking individual projects and keeping all of their unique characteristics in the first instance and tokenizing them on-chain. So what we do is we basically take carbon credits that exist at a registry, move them into a registry account at an SPV. That SPV then issues special purpose vehicle, so it's bankruptcy remote and safe from any other corporate actions and anyone who might try to attack that vehicle for the purposes of removing the carbon credits as collateral or anything like that. They're there purposely just to be linked to a token that's issued by the SPV, and that token represents that exact carbon credit. And then what can happen is you can start bundling these carbon credits together. So you can take like kinds of carbon credits that have the same use case, same characteristics, put them together as a bundle to create standardization. And then you have essentially 4 functions on that bundle that is liquid and accessible to everybody. You can retire the carbon credit, so it can actually just go and use that for your offsetting purposes. You can redeem the credit back, so you can actually go back off-chain with that credit if you want to. You can unwrap it and select a specific project from inside the bundle. Or you can just hold it and keep that asset basically in your portfolio, hold it for later offsetting use, buy now, retire later, buy now to provide liquidity into the market. So lots of different use cases. And then again, the bundle itself becomes programmable. And so what this does is it increases access. By tokenizing this, you create a permissionless asset that anyone can interact with. Right now, it's very difficult to interact directly with carbon credits. You create deeper liquidity, very good at that in DeFi and Web3, very good at incentivizing liquidity. You have transparent pricing. You can actually see what the carbon credits traded for when they trade. You can get more funding because you'll actually be able to see the price and have risk mitigation strategies, and you get this wonderful composability. And so that leads to all different kinds of use cases, right? Where you can actually have many different bundles that represent different kinds of carbon credits: cook stoves, nature-based, biochar, tech-based removals, tech-based avoidance. And then you can create all sorts of great use cases. And so some of the use cases that we've talked about and have already been seen evolving in this market is automatic offsetting. So we've seen protocols, Celo was the first protocol to do this, and they basically said, we're going to take a little bit of our validator rewards every epoch, and we're going to take them and use them to buy and retire carbon credits. And doing that on a periodic, essentially automatic basis is now becoming a trend for L1s and L2s. So we've seen several other L1s and L2s start to be interested in and agreeing to doing automatic offsetting at the protocol level. You can build loyalty reward programs in the form of carbon credits. So you can give, C-Charge, for example, is an EV charging network, and they are rewarding people for using their network by actually giving them carbon credits on top of that. And so they get a reward in the form of carbon that they can then retire for further environmental benefits or use in other ways. Direct delivery, which is super important right now. Investors in carbon projects have a really hard time when you invest in a product that issues carbon credits. They don't have registry accounts, and so they can't actually take the carbon credits. They have to find and work with an intermediary who's going to hold them on their behalf, and oftentimes that creates a lot of friction. And then carbon claim tracing, so sort of what Alan was talking about earlier this morning, and lots of other people are building. Supply chain management is coming through, where we're actually tracking all of the different carbon footprints of every different action inside of a supply chain, and if various different parties along the way offset the footprint to actually make it net zero, you can actually now track that, record it, have hypercerts that give you actually that proof point, and keep all of that information on-chain using on-chain carbon. So bringing this all back together, we think this creates a massive flywheel to actually scale and grow the voluntary carbon market. By delivering financing and early stage capital, we get to then structure that capital, make that capital more risk adjusted so that different investor types can invest in different parts of the stack, tokenize the spot asset, which creates this whole system and usability of carbon credits, leads to innovative use cases, which actually comes back to financing because those innovative use cases will spur more demand for carbon credits, and therefore more financing will flow into the system. So we're always looking for new partners. We're looking for people to help build with us. And if anyone has any questions at this point, please, I'd love to ask them now, or you can feel free to reach out on Twitter or Telegram.
Anyone who have a question?
Hey, Phil. Great presentation. Pretty broad, great comprehensive story. Really loved it. So question for you is, where are you in your current journey, in your build? What exactly has been issued from issuance perspective, and from financing perspective, which jurisdiction are you specifically talking about, from creating these forward contracts, etc.? So pretty keen to understand that.
Yeah, so on the spot tokenization side of the market, there was a pause put on last year by the issuers of carbon credits towards tokenization. So that technology stack is fully built out. We're very hopeful that by the end of the year, Gold Standard being the first major body to move, will have their guidelines for tokenization and open tokenization back up, and that will then be the first thing to be deployed on that side of the market. On the financing side, we've done one financing structure on-chain. We're starting to do more financing structures on-chain. And in terms of where in the world, truly it's a global market. Right now, the goal is to find and finance projects that will spur more investment. So we're looking at how do we mitigate risks in the projects that we're investing in, right? We don't want, even though these structures are set up to have some failure tolerance, right? The idea is to not have them, the projects do that at all, especially in the early days when we're trying to prove to the institutional market that these are really good, solid investments that will yield returns. And so that is unfortunately limiting certain parts of the world from a geopolitical risk standpoint. And there's a lot we can get into on why those geopolitical risks exist. There's the possibility that countries could nationalize their carbon production or heavily tax. We've seen 50% take rates by governments for carbon production that's exported. And so in situations like that, you want to sort of avoid those scenarios so you don't end up in a very bad situation, and focus more on areas where there are very well-established property rights, and that's not, or they already have implemented policies around nationalization of the carbon industry.
Hello, Phil. Thank you for your presentations. I have a question, maybe more technical, from how you manage to, as carbon credit is, like you say, not fungible from the project point of view, and then you put them together in the bundle, which will be like an ETF from the carbon credit. If I want to buy specific carbon credit from a specific project, I will be able to do it, or I need to buy only ETF one, or can I take, in the other way, can I take a carbon credit from your ETF and recompose it on a specific carbon credit from project?
Yeah, great question. So from a legal construct, right, the way that we've developed the system is it was very important to us to maintain the spot commodity status at all times, and to follow through a legal and creation construct that didn't all of a sudden create something that looks like a security, or that looks like a pool of commodities, which has specific regulation in the United States of how those things are done. And so the construct that we've designed actually allows for one credit to equal one bundle credit. It's a one-to-one match. And then because of that, you can always unbundle and select something specific from inside there. And that's what allows you to basically keep that status. So if you want to pick a specific project, you can. One of the innovations that we're working on is how do you actually differentiate when there are slight differences inside of a bundle of carbon credits, and maybe there is some price difference right now, how do you actually programmatically differentiate that to have a fee setting that's like an internal closed system fees to incentivize and disincentivize the removal of specific credits? Because what you don't have, unlike an ETF in this construct, is a claim on a little piece of each one. Right, you have a claim on, you only basically, if you own one bundle token, you have a claim on one carbon credit, and that is programmatically determined. And if you want to pick a specific one, there's going to be a fee associated with it, or possibly an incentive.
Okay. Thank you, Phil. Thank you, everybody. And hope you enjoyed the speech and you will stay here for the next one.
Thank you.